The Fed has just signaled an even higher interest rate expectation for 2023, with the terminal rate forecasted to peak between 4.75 to 5% by spring, and markets have turned sour again after a week-long rally. In times like this, it's best to concentrate most of our portfolios on the safest bets we have, while the markets are on a risk-off phase to effectively mitigate risk while not missing potential gains. And we're here to make sure you won't miss any good opportunities ahead. We do tons of research about the stock market, and in this video, we're sharing the best 5 value stocks to buy now. If you like this video, make sure to destroy the like and subscribe buttons so that you won't miss any of our future content. Make sure to stay till the end, as our last stock pick is our favorite, and we think you'll like it too. Now let's get right into the video. First, we have JP Morgan Chase & Company. Bank stocks typically benefit from a rising rate environment because the higher the benchmark rate is, the higher the interest rates banks charge on their current loans, mortgages, credit cards, and the like. With this in mind, it's best to look into one of those titans of the banking industry. JP Morgan Chase & Company is a Delaware-incorporated New York City-based international investment bank and financial services holding corporation. With total assets of $3.954 trillion as of 2022, JP Morgan Chase is the largest bank in the country, the largest bank globally by market capitalization, and the 6th largest bank globally in terms of total assets. In addition, JP Morgan Chase is included as the 24th largest American firm by total revenue on the Fortune 500 list. Along with Bank of America, Citigroup, and Wells Fargo, it is one of the Big Four banks in the United States. JP Morgan Chase is regarded as a custodian bank and a universal bank. The divisions of investment banking, asset management, private banking, wealth management, commercial banking, and treasury services all operate under the JP Morgan name. At the start of the COVID-19 outbreak back in Q1 of 2022, JP Morgan Chase & Company's stock price tanked by roughly 45% from a peak of $140 a share at the beginning of 2020 down to $77.52 a share in March of the same year. While this presented a window of opportunity to accumulate JPN stock at a bargain, the stock's recent rally has invalidated its long-year downtrend and is poised to reach higher levels. The acquisition front has seen activity. The firm recently acquired Global Shares, a leading cloud-based provider of share plan management software, for an undisclosed sum. By closing that agreement, JP Morgan's wealth management businesses will have a new customer acquisition avenue and will be able to offer a wider range of services to corporate clients. Additionally, JP Morgan has agreed to buy Renovite Technologies, a well-known provider of cloud-native payment technology. According to the company's leadership, this change will increase the company's merchant purchasing capabilities flexibility on a global scale. Based on the numbers we've gathered, JPM has grown its revenues from $92 billion in 2012 to $131 billion in 2021. Its operating margin has significantly grown from 23.2% in 2012 to 36.9% in 2021. That's an average of 27.5% over the past 10 years. What's more, the return on equity has averaged 11.2% over the same period. Everything looks good when we look at the stock valuation for JP Morgan. At its present share price and conservative earnings per share predictions of 4% annually, our model projects that JPM stock will have an annual returns of 14.5% over the next 5 years. Next up, we have Bank of America. Bank of America Corporation is a holding company for financial services and a multinational American investment bank with its main office in Charlotte, North Carolina. The bank was established in San Francisco, and Nations Bank of Charlotte purchased it in 1998, giving it its current shape. After JP Morgan Chase, it is the second largest bank in the United States. By market value, it is also the second largest bank globally. Bank of America is one of the Big Four U.S. financial institutions in the U.S., where it competes directly with JP Morgan Chase, Citigroup, and Wells Fargo for roughly 111% of all bank deposits in the United States. Its 3 main financial services are commercial banking, wealth management, and investment banking. Prior to the COVID crash of March 2020, the stock has been trading from a range of $32 to $35 and sharply plummeted to $18 due to extreme market fear, a whopping 49% drawdown from its peak. Since then, the price has recovered even above pre-COVID levels, yet is still trading at a 25% discount from its high at the start of the year. As the Federal Reserve continues to raise interest rates to combat inflation, this will help large U.S. banks increase their income from existing loans. When interest rates are rising, lenders like BAC often make more money because they can charge borrowers greater interest rates while gradually raising the rates they pay depositors. According to Morgan Stanley, who cited the corporation's third-quarter regulatory filings, the median bank would now report a 1.5 boost in 2023 EPS rather than the 2.5% jump it would have experienced from a previous half-point rate increase. Investors anticipate that the Fed will raise interest rates at its meeting in December. Numerous analysts believe Bank of America is among the greatest winners from increased rates. They have singled out Bank of America in particular as a candidate due to its capacity to increase earnings when interest rates climb. Bank of America's revenue has been growing, and you can see revenue has grown from $74 billion in 2012 to $94 billion in 2021. Net profit margin has averaged 21% over the past 10 years. What's more, its return on equity has averaged 6.9% annually over the same period. Our model suggests that given the solid fundamentals of the bank, its EPS is projected to steadily reach $4.50 in 2027 from $3.20 where it is at today, with a steady 7% annual growth over the next 5 years. With its current P/E of 11.6 times its net earnings, we expect the bank's P/E ratio to increase, and we expect a total annual return of 12.8% for Bank of America stock over the next 5 years. Let's move into one of the hottest sectors in the market, the energy sector. We'll look into two of our favorite picks and closely examine them. First, we have ExxonMobil Corporation. ExxonMobil Corporation is one of the leading global energy companies globally. It works on oil, gas, and petroleum product exploration, development, and distribution. Upstream, downstream, and chemical segments make up how it runs. Gas and crude oil are produced in the upstream sector. Petroleum products are manufactured and traded in the downstream industry. Petrochemicals are available in the chemical sector. John D. Rockefeller established the business, which has its headquarters in Irving, Texas, in 1882. Prior to March 2020, the stock was trading at around $70 a share. We've witnessed how the stock crashed from these levels down roughly 62% as the markets panicked on the potential global lockdowns. Since these levels, the stock has skyrocketed by roughly 230% to today's prices. One key to successful investing is to ride the trend because, as the adage goes, the trend is your friend. Indeed, energy companies have outperformed the markets, and we don't think they're backing down anytime soon. ExxonMobil posted yet another record profit as oil prices remain high. Since early this year, when Russia's invasion of Ukraine caused oil and gasoline prices to skyrocket globally, the oil giants have been reporting astonishing profits. ExxonMobil's adjusted profit over the 6-month period from April through September was almost $2,300 per second compared to its main competitor, Chevron, which only profited $1,400 per second. Based on the data we've gathered, ExxonMobil has booked an average of $290.5 billion in revenue for the past 10 years. Although revenue has dropped from $421 billion in 2012 to $286 billion in 2021. However, its operating margin has significantly grown from 15.6% to 29.3% over the same period. That's an average of 17.4% over the past 10 years. What's more, the return on capital invested has averaged 11.6%. At its current price, XOM still has much room for growth. At a price-to-earnings ratio of just 9.16x, the stock is still undervalued relative to the entire market. Coming up next is Chevron Corporation. Chevron Corporation is a business that produces renewable fuels. The business transports natural gas and crude oil, as well as refines, sells, and distributes fuels worldwide. Chevron Corporation was one of John D. Rockefeller's original Standard Oil Company's successors and was established in 1879. Since then, Chevron has expanded to become one of the largest global oil and gas businesses in the world, conducting significant business in 25 different nations. As of November 2021, the company is ranked at number 75 on Fortune 500's global list. Upstream and downstream operations are Chevron's two main business divisions. While the downstream operations include refining, transportation, and marketing, the upstream sector is involved in the exploration and production of oil and natural gas. Chevron also engages in technical development, real estate, insurance, and debt financing. Prior to March 2020, the stock was trading at a range of $107 to $130 a share consistently and tanked 57% from its peak when the global markets were crashing. Since then, the price has steadily increased by 245% to today's market price. This year, Berkshire Hathaway, led by Warren Buffett, has drastically increased its holding in oil and gas firms, investing $12 billion in Occidental Petroleum and $25 billion in Chevron. In a recent episode of the We Study Billionaires podcast, Josh Young, the founder and CEO of Bison Interests and an expert in energy equities, explained Buffett's likely justification. According to Young, Buffett and his group are probably positive about energy prices, which have risen as a result of Russia's invasion of Ukraine disrupting supplies worldwide. He went on to say that they probably decided that both firms were undervalued and appreciated their management teams, and that their options were probably restricted to choosing an industry participant with the power to significantly affect Berkshire's financial position. Based on Chevron's numbers, the company has booked an average of $165 billion in revenue for the past 10 years. Though revenue had also dropped from $242 billion in 2012 to $162 billion in 2021, its operating margin has significantly grown from 24.9% to 29.4% over the same period. That's an average of 22.3% over the past 10 years. Chevron's return on capital invested has also averaged 7.6%. Everything looks promising when we look into Chevron's current valuation. At its present share price and conservative earnings per share predictions, our model projects that CVX stock will have annual returns of 16.1% over the next 5 years. Pfizer. Let's drift away from the banking and energy sectors for now and look into our last stock pick. This company has always been in the headlines during the duration of the pandemic and is one of the world's premier biopharmaceutical companies. Yes, you might have guessed it right. I'm talking about Pfizer, PFE. Pfizer Incorporated is a huge, internationally recognized biopharmaceutical firm. It is involved in the worldwide discovery, development, production, marketing, sales, and distribution of biopharmaceutical goods. The business advances wellness, prevention, treatments, and cures that take on the most feared diseases in both developed and emerging countries. The business's headquarters are in New York, New York, and it was established in 1849 by Charles Pfizer Sr. and Charles Erhardt. The stock peaked at $38.66 a share at the beginning of 2020, yet crashed simultaneously with other global stocks when the pandemic hit. It plummeted roughly 30% from its peak and has steadily recovered since then. Peaking at $61 a share at the start of 2022, the stock is down roughly by 24% year to date. Pfizer disclosed solid fresh data on its maternal respiratory syncytial virus study in addition to earnings that exceeded Wall Street expectations. By the end of the year, the business hopes to submit the injection for Food and Drug Administration approval. This puts Pfizer on track to conceivably release an RSV vaccine for seniors next fall. In late 2023 or early 2024, it might release one for expectant mothers. RSV is a widespread virus that typically only produces a mild illness in young infants and adults, but it can also have major side effects. Only Pfizer seems to be going forward with an RSV vaccine for expecting moms that are meant to protect their newborns, while a long list of other companies is working on RSV vaccinations for older adults. Looking into the numbers over the past 10 years, the company's revenue has grown from $59 billion to $81 billion with a 46.2% operating margin. Moreover, its return on capital invested has averaged 11.4% over the same period. Our model suggests that the stock is still relatively undervalued compared to the overall market, with a P/E ratio of just 8.96 times its earnings. This biopharma company's future post-pandemic is still bright, given that the world has learned so much and has developed at an unforeseen pace thanks to the urgency that this pandemic brings. There you have it, folks. Those are our top 5 value stock picks for this week. Comment down below your favorite stock pick, and if you enjoyed our content, don't forget to hit the like and subscribe buttons, and we hope you have a truly amazing day ahead.